Have you ever looked at a European city and thought, property prices are ridiculous, I'll never get in? Today, we're asking whether there's a smarter route into real estate without the mortgage, without the estate agent, and without the keys. Quick note before we dive in. This video is for educational purposes only and is not financial advice. Please do your own research and consider speaking to a qualified financial advisor before making any investment decisions. Welcome back to the European Investor. We're talking about REITs, real estate investment trusts, and whether they still make sense now that the ECB has raised its benchmark rate to 2.25%. So what exactly is a REIT? Think of it as a company that owns income-producing property, offices, shopping centers, warehouses, apartments. Listed on a stock exchange, just like any other share. You buy a slice, and you receive a share of the rental income as a dividend. REITs are legally required in most European jurisdictions to distribute a large proportion of their taxable income to shareholders. That means regular, predictable income without owning a single brick. Now let's set the scene. The European Central Bank's deposit facility rate currently stands at 2.25%. That's modest compared to the peak of the hiking cycle, but a far cry from the near zero rates that powered the property boom of the 2010s. When borrowing is cheap, REITs can use debt affordably to grow their portfolios. When rates rise, that equation gets more complicated. Here's the pressure channel. REITs carry meaningful debt. They're capital intensive by nature. When rates rise, refinancing that debt gets costlier, squeezing distributions. At the same time, higher rates push up yields on safer assets like government bonds. When a German Bund suddenly offers a reasonable yield, income investors have an alternative, and REIT valuations can fall as money rotates out. But here's the counterforce. Across major European cities, Berlin, Amsterdam, Dublin, Lisbon, Paris, there's a structural undersupply of housing. Planning restrictions, high construction costs, and population growth mean demand for rented property consistently outpaces new supply. When you own the supply everyone is chasing, you can push rents higher, and that feeds directly into REIT revenue. So we have a genuine tug of war. On one side, higher ECB rates raising debt costs and pulling capital towards bonds. On the other, a housing market so starved of supply that landlords, including REITs, hold pricing power. Which force wins depends on the type of REIT, its debt maturity profile, and its property sector. Not all REITs are created equal. Let's compare the two routes head to head. Buying a property directly means locking up substantial capital, paying transfer taxes, legal fees, and maintenance, and selling can take months. A REIT you can buy or sell in seconds during market hours, starting with whatever you can afford. That liquidity and low entry cost is real monetary value that rarely shows up in a simple yield comparison. Buy a single apartment and you're entirely dependent on one building, one tenant, one city. A REIT might own hundreds of properties across multiple countries and sectors. Residential, logistics, healthcare, commercial, all in one instrument. Leverage works differently too. A mortgage makes you personally liable for every payment, whereas a REIT's debt is managed professionally with covenants and hedging, and the risk is spread across thousands of investors rather than concentrated on your balance sheet. European REITs are not a monolith. Residential REITs in Germany and Sweden are closely tied to rent controls. Logistics and industrial REITs have benefited enormously from e-commerce and remain in structural demand. Healthcare and senior living REITs serve an aging population with long-term leases. Office REITs are the most debated given the shift to hybrid working. Which sector you're getting exposure to matters enormously. Two things reveal how exposed a REIT is to today's rates: its debt maturity profile and its valuation. Check the weighted average maturity and the split between fixed and floating debt. A company that locked in long-term fixed rates before the hiking cycle is far better positioned than one relying on floating borrowing. Meanwhile, many European REITs now trade at a discount to net asset value, meaning the share price sits below the estimated worth of their properties. That gap can reflect pessimism the market has already priced in, or it can reflect real unresolved risk in that REIT's debt or property portfolio. It's a data point worth researching further, not a signal to act on by itself. For European retail investors, the most accessible route is typically a UCITS-compliant REIT ETF, available through any standard broker, denominated in euros and covered by European investor protections. These track indices of listed European real estate companies, giving instant diversification without needing to pick individual REITs, usually at low ongoing charges. Two more things worth knowing. Tax treatment of REIT dividends varies considerably across European countries. Some tax them as ordinary income, others apply a reduced withholding rate. so check your own country's rules, especially if you can hold them in a tax-advantaged account. And real estate has historically offered some inflation protection, since landlords can often pass on rising replacement costs through higher rents, particularly when supply is tight. Balance requires honesty about the risks. If the ECB keeps rates elevated longer than expected, refinancing costs stay high and valuations may face further pressure. If the economy slows sharply, commercial occupancy rates can fall too. Residential REITs face regulatory risk, rent caps, or new tenant protection laws can limit income upside, and listed REITs move with the stock market short term, meaning your portfolio value can fall sharply even if the underlying properties are fine. How does a REIT fit into a balanced portfolio? Real estate has historically had a relatively low correlation with equities and bonds over the long run, making it a useful diversifier. Though in the short term, especially during market stress, listed REITs can move more in line with the broader equity market. For a long-term investor, a modest allocation alongside equities and bonds can provide income, diversification, and some inflation resilience without the illiquidity of owning physical property. If this is a space you want to explore further, start by looking at USITS ETFs that track European real estate indices. You can find them through any major broker. Check the underlying sector mix, the fund's ongoing charge, and whether you want accumulating or distributing units. Then, if you're interested in individual REITs, look at their debt maturity profile and current NAV discount before buying. This is a long-term asset class, not a short-term trade. Take your time. So, are European REITs still worth considering at 2.25% rates? The answer is nuanced. The rate headwind is real and shouldn't be dismissed. But the structural undersupply of housing, the valuation reset already priced in, the inflation hedging quality of real estate income, and the access and liquidity advantages over direct property all remain valid arguments. For a patient, long-horizon European investor who wants property exposure without the burden of ownership, REITs remain a credible tool, provided you understand the sectors, the debt profiles, and the risks. That's all for today's episode of The European Investor. If you found this useful, hit like and subscribe. We publish new episodes every week covering investing topics relevant to European retail investors. Our free newsletter in the description goes deeper on each episode with extra data and reading recommendations. And remember, everything here is education, not financial advice. Do your own research and make decisions that suit your own situation and risk tolerance. I'm the European Investor. Thanks for watching, and I'll see you in the next one.